Welcome back. We've been discussing the Reserve Bank's decision to keep interest rates unchanged. Inflation outlook rather dire, and Colin was just about to tell us something about something even more dire. Colin, GDP. When Jill Marcus took over, she got an unofficial mandate to focus on growth and inflation. I suppose that's gone now.
Yeah, I think it's good that the Reserve Bank looks at the GDP forecast, because it is part of the flexible mandate that it got in 2008. It got obviously the inflation gap, it got the output gap, it got the labour market, asset prices, credit growth. Those are basically what it, the main indicators that it has to consider in making a decision. I mean, amongst many others. But I think in this particular case, what is interesting is that the Reserve Bank has made reference to GDP growth falling to 1.5% this year. We were over 2% at the beginning of the year. And I think in the context of the speculation regarding the major credit rating agency, Standard & Poor's, downgrading the sovereign credit, I think this is an important signal to the market. Certainly one I feel that the Reserve Bank may not have made in isolation, that is probably also consulted with the National Treasury on this. We have the medium-term budget policy statement coming up on the 21st of October. And we got speculation that, Nene will, Finance Minister Nene will cut the GDP, but to what level? He started at 2.1% at the beginning of the year. We're now down to where? So I think the indication that the MPC statement has given me is that we may well see the GDP for this year cut to 1.5% by National Treasury. But, sorry.
That doesn't sound good.
No, it doesn't. For so many different angles, because your main financial stability ratios are referenced against GDP, your fiscal deficit, your public debt, interest on servicing debt, your PSBR, and current account deficit, which, thank goodness, is turned the corner there. We don't know for how long, but we'll take good news when we can get it, in this particular case. But I think the Reserve Bank, it says, if I read the statement, it says it's talking about the leading indicator, and it's saying it's exhibited a more pronounced downward trend in recent months. Now, if you work out the annualized growth in this figure, it's been contracting for 18 consecutive months. It's been telling us what we now know and speculating more and more about for a while, that we may well be in recession. We don't have to wait for the official numbers. We're already there. So the GDP forecast of 1.5%, this comment about the leading indicator, that downward movement being more pronounced, I think we need to be taking a little bit more, paying more attention to it.
Alex, does that not sort of constrain the SABC's ability to hike?
Without a doubt. I think if GDP growth had been higher at this stage, the SABC would have been more aggressive in terms of interest rate hikes, and that quite possibly would have hiked today as well. I mean, typically when you see this level of currency depreciation come through in such a short space of time, you do start to consider monetary policy tightening. But I think the point that Colin makes is an important one, because if the Treasury is going to cut its growth forecast at the medium-term budget policy statement next month, that also has important implications for fiscal policy going forward, right? Because it implies that there's a good chance that the Treasury is not going to generate as much tax revenue as it had hoped at the beginning of this year. And as a result of that, it raises the risk that there might be additional tax increases for the Treasury to make sure that they get their budget forecasts so that we don't get a sovereign credit rating downgrade. And so that may also be playing on the MPC's mind, because remember, fiscal and monetary policy can work together. So if the monetary policy makers are anticipating that there will be fiscal tightening, i.e. that there will be higher taxes, that might be doing some of the work for them in terms of reducing domestic demand and reducing inflation in the economy. So that might also be something that's playing on the MPC's mind at this stage. And perhaps they know something that we don't, or perhaps they're just waiting to hear the MTBPS next month and find out maybe a bit more detail about what Treasury is going to do on their side, whether they'll be tightening from the fiscal side and maybe then the monetary policy makers won't need to tighten.
The key to this is the current account. Are you convinced that we've turned the corner on it?
No, unfortunately not. It was very nice to see the current account deficit narrow so much, but the problem that we've got is that our terms of trade is under a lot of pressure. So what that means is that the values of our export commodities are declining. And as a result of that, we need to export more volumes to keep up with
Which
with
in
the
turn
declining
depresses
values.
the price even further.
Well, that too. Unfortunately, we're not price makers in a lot of these goods, so it doesn't matter too much. But the fact of the matter is that our ability to export more volumes is constrained for various reasons. I mean, electricity is one. We've got labour issues. There's the risk of perhaps a strike in the gold mining sector coming up soon. And then we've also got the low prices, which is making a lot of mining companies consider actually cutting production or putting mines on care and maintenance. So I'm very concerned about the commodity price outlook, and because of that, I think there's still a lot of risk to the current account being in deficit, in a fairly significant deficit.
Colin, to me it sounds like the Reserve Bank is hamstrung at this point. Although they feel they have to hike interest rates, the economy doesn't really allow for it. Is there another option to come get around their dilemma? Perhaps the SARB cannot go it alone anymore.
The Reserve Bank is caught between a rock and a hard place here. It has to respond to the currency, and one may say, but why? You know, it's about the impact the weak rand has got on imported inflation. That will come through. In fact, we probably will see more of it in the months ahead. And the Reserve Bank is really flagging that concern. And its mandate is, and I think this is what we mustn't forget, it will be sensitive to the outlook towards GDP growth, but its mandate is primarily inflation. So if it feels inflation is maybe breaching the target aggressively, if it goes to 7%, for example, there's a good chance it hikes. Or if it feels it goes up to 7% and then comes back quickly, it may pause and say, I'll sit on my hands, I'll wait for that inflation, that price shock to work its way, out the system. Unfortunately, as I look at it, it doesn't seem to have too many options to play with. The interest rate card is the only one that it has. And, Alec points out the current account improvement being unsustainable. We forget about the flows, the capital flows that we need to support that deficit if it turns around. And one of those flows happens to be interest in high-yielding markets. Put your interest rate up and reverse the capital flows. But if you do spike your interest rate, you have to reverse it very quickly because you will damage the economy.
Okay, well, one thing we are left with is at least we don't pay on our mortgage, but the uncertainty continues. It's no wonder the governor, first thing he mentioned was the Fed didn't change. That brought the uncertainty back into global markets. Gentlemen, thank you for your time.
Thanks very much.
Alex Smith from FNB, Colin Garrow.
Good, thanks very much.
Lefika Securities. Here we go. Time now to move on. We thank you for your time. Bye-bye.